How to make money with 1,000 ounces gold bar. 2009 was an extraordinary year for the gold market. From a low of $811 at the beginning of 2009, an ounce of gold touched a nominal all-time high of $1,226 in December, up 40% from the start of the year. Although this gain is closer to 25% in constant currency terms, the rise since the end of the 90s is nonetheless 400% in nominal terms. Amongst this buying frenzy, some commentators are suggesting that gold has become the latest asset to enter a speculative bubble, while others look to macroeconomic fundamentals to argue that investment demand is and will remain unquenchable. Gold skeptics often point to the metal's lack of utility. Aside from jewelry and small electronics applications, gold is of little practical use in industry. You can't use gold for payment of taxes or mortgages, and it is expensive to store. Furthermore, gold yields no return, unlike equities, bonds, and bank deposits, thereby increasing the effective cost of storage. From a supply perspective, skeptics have more ammunition. The world's central banks hold 32,000 tons in their vaults, which is enough to meet global demand, as measured by last year's consumption, for another 8 years. Furthermore, according to GFMS, the London-based gold consultancy, global mine supply rose 6% to 2,553 tons in 2009, a 6-year high. Consider the plight of central banks outside of the U.S., particularly those in economies that run a large trade surplus such as Japan, Germany, Canada, and China. A weak U.S. dollar, zero interest rates, and a pile of new dollars hot off the printing press at the Federal Reserve have central bank officials contemplating the real future value of their currency reserves, which for the most part are made up of U.S. dollars. In particular, China and Japan, by far the largest holders of long-term U.S. government debt, are becoming concerned about their savings and the creditworthiness of their debtors. At the recent World Economic Forum meeting in Davos, Terry Smith, chairman of the Committee on World's Banking Crisis, opined that 2/3 of the world's assets are denominated in currencies that are being debased by key policy actions. Countries like China are not happy about that. Put simply, foreign central banks are now looking for a reserve asset that offers a more long-term store of value in the face of economic and systemic uncertainty. And the perception is that gold is in their crosswires. In evidence of this, India's Reserve Bank recently bought 200 tons of bullion from the IMF. Whilst this in itself is significant, more so is the expectation that other governments may follow suit, lending huge psychological support to the market. Of incomparable importance will be if China followed this trend. China's central bank reserves are so vast that if it were to double its gold reserves, it would be required to buy half the global annual mining output. Indeed, with gold representing on average 10% of reserves at G7 member central banks and only 2.5% in those of emerging market nations, gold is set to benefit even from any normalization in emerging market gold reserve ratios. Gold prices have been further boosted by a slowdown in central bank supply. Sales from central banks have virtually dried up in 2009, dropping 90% year-on-year to 24 tons. Adding further momentum to the gold surge is the recent emergence of gold bullion-backed exchange-traded funds, which offer institutional investors a readily tradable vehicle to own a fraction of gold stored in a vault. ETF buying has boosted the commodity market in general, with assets in commodity ETFs rising from $35 billion a year ago to over $75 billion today. Whether you're a bull or a bear, trade your view with World Spreads Ireland. You will get excellent value on the spreads. At noon on January 18, World Spreads offered 100% better value in gold rolling than its only other competitor with a trading desk in Ireland.